Giving up the gains, futures are sharply lower after the historic rally yesterday. The Dow soaring almost 1,100 points, its biggest single-day point gain in history, now down 403. Joining me now, FS Investments Chief Economist Lara Rhame. Thank you for joining us.
Yeah.
Does the rally yesterday, did it take the recession talk out of the market or not at all because of the sell-off this morning?
Yeah, I think that these wild swings have had so little to do with what's going on with the underlying economy. And when I look at yesterday's rally, I have to think that, you know, people opened up to the headlines that we've had the strongest shopping season throughout this expansion, very strong and confident consumer out there. You know, what are we all so worried about? And it really put the Christmas Eve sell-off into some perspective. We got some rebound, but the volatility is unnerving.
Go ahead. Well, I was going to ask on the downside, this Richmond Fed manufacturing report was sort of shockingly, surprisingly bad. And I'm wondering, do you look at that as a one-off, a blip in a larger trend, or is that...
actually, there are two or three of those manufacturing indices that come out.
Yeah, a couple of the small regional manufacturing indices have started to roll over. You know, the national PMI numbers are a little lower, but, you know, we're still lower from extraordinarily high numbers.
Right.
And I think at our core, we're still really a consumer-driven economy. So when you have the consumer out spending, it's hard to, you know, model a scenario where you get a recession, a slowdown from 2018, possibly because it was so strong, but still a really solid economic performance. This volatility is really a signal of something else.
Lara, people are not quite trusting the consumer, the holiday spending numbers and stuff, because they say it's all debt-driven. How do you answer that?
So, you know, I don't see it that way because the consumer is more, you know, the consumer has started slowly to eat into their savings, but the savings rate's relatively high compared to past expansions. And if you look at overall consumer debt, it's really much more managed than it was, say, this time during the last expansion.
And with interest rates going up, if you have savings, you can make a little bit of money on them.
A little
That's
more,
something
yeah.
Millennials particularly don't know anything about.
Yeah, you know, during the last several years when the equity markets have been so robust, we didn't see the wealth effect kick in like in the 90s, the late 90s, which I remember well. You know, we really saw strong equity gains pushing a lot of consumption. I don't know if this is a different consumer, a consumer that really has internalized the lessons we learned from the last expansion. I don't know if any of us really changed that much, but the reality is that I think really this is driven by a strong labor market, 3.7% unemployment rate, and the fact that we're finally starting to see some more broad-based wage
Lara,
gains.
I've taken some econometrics classes undergrad, and I got to say the I'm going to hit you with some statistics. No, the forecasting ability of economists is weak at best. It seems like they're strong. When you look at cardboard sales or oil or whatever, it seems like their strongest stuff is the inverted yield curve and the stock market being down 20%, a bear market. Those tend to happen with recessions with better accuracy than all this other stuff we're talking about. Do those worry you that a recession is around the corner, given that those two are sort of flashing the warning lights right now?
So the equity market's not as much because I really feel like these P swings are driven by something else. We're seeing the algorithmic trading. We're seeing passive investing. I think that's giving us a lot of volatility. The yield curve bears close watching. And I think something that we forget is the fact that, you know, normally an inverted yield curve is driven purely by short-term rates being, you know, knocked up by the Fed in a very rapid pace. But nowadays, because of all the international geopolitical problems, we're seeing this flight to quality trade that pushes long-term interest rates down. I know that seems like a lot, short-term rates, long-term rates.
Well, that's the recession indicators that people investors who buy long-term bonds think that there's going to be deflation in a recession. That's why they're doing that. That's why it's a forecast.
But is it
What's a better forecast than those two?
Is it U.S. investors? You know, consumer confidence is, to me, the economy looks like it's going fine until consumer confidence falls off a cliff.
We're confident right now. We might be on the Krispy Kreme high or the Christmas high, but we do have a government shutdown. And I know historically that doesn't impact the stock market all too much, arguably doesn't impact the economy, but we're not getting some of the data. Commerce Department won't give us new home sales today. Yeah, that's backward looking, but it's still data. We do get jobless claims from labor later this week. My point is, how long does this go, and can this shutdown, because it is different this time around, or it feels different, will that impact the market?
You know, I just think it's this continued overlay of uncertainty coming from so many different sectors. And you layer that on with the automated trading that now is such a large portion of the flows that we see. To me, the forecast that's the strongest is much higher volatility in 2019.
Right.
That's why we're really, I think, still trying to manage around what is going to be a year where, with a lot of continued political headlines, a lot of continued geopolitics, and, you know, an economy that's solid, but we have to make sure that that doesn't blow back and hit the consumer too hard.
Lara Rhame, thank you for your perspective.
Thank you.
Covered a lot of ground this morning.